Well, not that kind of volatility day after day. I mean, you're seeing, 5 to 10% moves. I've never seen anything like that. It's crazy.
Gold and silver investors have been rocked over the last couple of weeks. We speak to veteran value investor Jonathan Wellum, the president and CEO of ROCKLINC Investment Partners and the former money manager to billionaire Michael Lee Chin, for a value investor's guide to precious metals.
So you have seen large buying of gold now. I think it's third or fourth inning. I think we have a lot more to go.
Why Sprott now?
They're going to get tremendous operating leverage in their business. They are an attractive takeout candidate also.
What's your signpost for avoiding value traps?
There's no question. I do not trust the fiat banking system at this point.
When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. In this episode, we discuss Equinox Gold and Constellation Software, which are both stocks that I own. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. All month long, we were collecting swag ideas and we've narrowed it down to 8. And now you get to vote on which ones we're going to make up. We have some apparel, we have some mugs. Market Cap as a hat made the final cut. Free Jerome Powell as a mug made the final cut. We've got a Gap sweatshirt, GAAP. Which one do you like, Jillian?
I like that one.
She likes that one. She likes the Gap one, but you said you wouldn't wear it. So I don't know. It's got to come down to some wearability here. Anyway, you can vote in the show notes. Wherever you're watching, you should see a link, a SurveyMonkey link. Please click on it and we'll collect it. And then that will be our next swag giveaway. Also, I'm going to plug for my newsletter because if you don't want to click that link, you can go to our website, inthemoneypod.com. I write a daily markets newsletter. I'm going to be putting the survey in that newsletter, but I cover basically everything that's happening in the markets that day. So smash that subscribe button, as we like to say. Go to inthemoneypod.com. All right. This episode, we have Jonathan Wellum of ROCKLINC Investment Partners. He is a veteran value investor. He used to manage Michael Lee Chin's money when it was Portland Investment Council. Michael Lee Chin, of course, is a Jamaican-Canadian billionaire. And that's really where Wellum kind of learned the art of value investing, is a disciple, I'll say, of Warren Buffett, but where he departs from the school of Warren Buffett is when it comes to precious metals. He's got a huge exposure, 25% exposure in the portfolio to precious metals. We talk about what he's doing because of the volatility that we've seen, how he plays defense in a momentum-driven sector. And we also, because he's a value investor, we talk a little bit about software. That sector has absolutely been eviscerated recently on concerns that AI is going to eat into software. So he's got some ideas, some selective places that he's nipping away. We talk a lot of stocks, a lot of actionable ideas. So as always, let's get into it. Jonathan Wellum, thank you so much for joining me on the podcast.
Well, it's great to be with you, Amber. I'm looking forward to our conversation.
Me too. I can't believe we've actually never spoken before because you're sort of a veteran in the industry. And with people I don't know that well, I like to start a little bit with your background. I think of you as sort of a value investor. And you worked with, Canadian billionaire Michael Wheaton back in the day. So tell me a little bit about your origin story.
Yeah, I was always interested in the stock market. So I went to university. I did a commerce and MBA degree, and I met Michael actually working out at the gym at McMaster University. And we struck up a friendship. And I also met my wife there too. And that's now 32 years later. But I met with Mike in the gym, and we struck up a friendship. And when I finished my schooling, he said, "Why don't you come down and work with me? I've got this little small company in Hamilton." They had $12 million in assets. There was just 2 funds. And I said, "Okay, let's do it." And he said, "You'll have to do a CFA." And I said, "Not a problem. I love the investment business." And so he brought me into the industry in 1990, and we struggled for a number of years. It was tough going. It was a small firm, and he had a financial planning operation around the mutual fund company. But around 1995, 1996, it went straight up. Our performance was off the charts. We all of a sudden billions of dollars kept coming in, and that business went up to as high as $15 billion. So it was quite the run. So I was fortunate to be there. I was the president and then became the CEO in the later days, and I was the chief investment officer. So it was one heck of a run, and it was a lot of fun.
And ultimately that business got sold to
Manulife. So in 2009, Michael sold the business to Manulife. The economics were changing in the industry, and he was in big investments down in the Caribbean. And so he decided he wanted to sell. And I thought that was good timing. And so 2009, and then I set up my own company now, ROCKLINC Investment Partners, in 2010.
So that's an interesting time to come up in the industry, 1990s, experience that euphoria, and then experience whatever the opposite of euphoria is with the financial crisis. And I think about Michael Wheaton, it's kind of classic buy, hold, prosper. Is that sort of your ethos as well? And if you think about what was the key to your success on the way up, and what did you learn about managing things on the way down?
Yeah, great questions. Yeah, I mean, when I got in the business in 1990, the Michael pointed me to Warren Buffett. He said, "Jonathan, you need to learn everything you can about Warren Buffett." And so that's what I did. Michael was a follower of Buffett from the mid-'80s, actually. So long before a lot of people knew much about Warren Buffett. And we started going down to the annual meetings. I started in 1993 and went down about 18 times. Michael was going even before me.
Wow.
And so I got ensconced in value investing, trying to buy great companies, do the research, focus your portfolios, don't be all over the place, understand the companies well, and then stay there as long as they remain great companies and they continue to grow. The benefit of that, of course, is tax-deferred compounding, which is something that a lot of people in the investment industry really don't focus on. But wealth is created if you can, tax defer and then compound your wealth. So, no, I'm still very much ensconced in value investing. I think once you get fixed in principles, then you don't change. So it's been a lot of fun. Now, you do learn on the, as you say, on the way up, we took advantage of the leveraging up of the financial system. So out of the 80s, as you might, you weren't living in the 80s to recall that, but you can read the history books.
Yeah.
The interest rates were coming off of historic highs. People were running out of GICs. They had most of their investment in interest-bearing securities, and they were going into mutual funds. And so there was a leveraging up of the industry. People were borrowing more. The baby boomers were coming on the scene. And so we took advantage of that through investing in banks and also mutual fund companies. So we were a mutual fund company, but we saw the opportunity to buy mutual fund companies who were proliferating all of these funds that people were buying. And of course, if you can buy up the chain, you can get at the company level, then you get all of the operating leverage of all that money flowing into the mutual funds. And so we did very well by buying, the Trimarks, the CIs, the Scepter Investment Council. AGF did very well at that time. They've had struggles since then. But so we bought it right across the industry, including some of the leaders in the United States, the Franklin Resources, which is the Ben and some other ones that we invested in. But
And it's interesting to hear you talk about you being sort of a disciple of Warren Buffett, focused on value. Buffett also loves those financials. How painful was that during the financial crisis?
Well, by that time we had diversified a fair bit. So we had assets in different areas, but we did have in a couple of our funds some large exposure to banks. We had launched some closed-end funds called the Copernican funds. And those closed-end funds had quite a few financials in it. In fact, we launched a British banks fund in 2007-ish type of thing. And those British banks right after that were practically eviscerated. I mean, there's just, Royal Bank of Scotland, Lloyds Bank, and so forth. I could go through the list, and I mean, they were just hammered. So the lesson there, from my perspective, which really shaped my investing now I'm at ROCKLINC, is, be careful of the debt that's been built up. So in the 1990s up until the 2000s, the debt wasn't a huge issue, although it was growing. But it was more at the personal level. We saw the mortgages. We saw a lot of consumer debt. The concern I have now is really government debt, is sovereign debt. So a lot of the investing I'm doing now at ROCKLINC, and the investments that we see the greatest opportunity is to protect ourselves from this massive buildup of sovereign debt. And the governments are just, they're out of control in terms of the debt that's been racked up.
And how you're expressing that is in mining, which is a big departure from Warren Buffett, right? He does not really believe in gold. Berkshire has not participated in gold. And I believe, correct me if I'm wrong, 25% of your portfolio is in precious metals.
Yes, precious metals, and related securities, although we've supported those investments through royalty companies to a large degree. We do have some mining companies also, but the royalty companies really are investment bankers. And so you do get the benefits of a financial and the consistency of a cash flow stream from the royalty companies. But there's no question, I do not trust the fiat banking system at this point. Even though I was a big investor, 20, 30 years ago and made a lot of money in that area, I think we've stretched ourselves in terms of our debt capacities all around the world, not just here in Canada. United States, Japan is in a big mess. The UK is serious financial problems, and the European Union also.
That's a big statement, to say I don't trust it, because another way to get out of debt is to grow your way out of it.
Yes.
And we are seeing actually quite resilient growth, and you could call it explosive growth out of the U.S.
Yeah, the U.S. is an exception. Right now, the U.S. is an exception. And I've spoken on this, and I think that you could see 5 to 6% growth out of the United States. And so they can delay this, I think, if they can grow their economy at 5-6% and they can maintain their deficits at 2 to 3% of their budgets. And so, but that's because Trump has unleashed, capital coming back into his country. He's cut taxes, cutting regulations. He's allowing permits to be passed a lot faster, especially for the extractive industries in the United States. And so, if he can reshore some of the industry, I do think that will be amazing for the U.S. So I'm positive in terms of the economics of what's going on in the U.S., despite the fiscal problems and despite the bigger, government debt issues. But the United States is an exception. If you look at the UK, you look at the European Union, you look at what's happening here in Canada, where we're just slow walking everything, and nothing's happening in this country. Or if you look at Japan, which is completely mired in debt, or China. I mean, China also has got serious financial issues. The U.S. is really quite the standout, and that's going to be hard to drive the whole global economy.
Japan will be interesting because they're about to potentially release even more in fiscal stimulus and more borrowing. So we'll see to what extent the bond market is okay with that.
And as you know, when you have a 350% plus debt to GDP, they make the Americans look like Puritans, in terms of the way they run their finances. So it's going to be interesting. And so again, we can't hide from all of this. We have to just find pockets of growth and pockets where we think we can at least protect our investors and make some money.
Let's talk about a few of those pockets before we get into the mailbag, because we have a lot of questions. But just talk about gold. People are flocking to it not because of government debt, but because central banks are buying, and then they're kind of ride those coattails. And then we saw tremendous volatility in gold. We'll get to silver, I promise. But in gold. What did that volatility tell you? What should investors do that maybe bought closer to the top and saw a really sharp move lower?
Right. Yeah, so when I started ROCKLINC back in 2010, we made gold and silver, these precious metals, about a 15% exposure right off the bat after the financial crisis. I was looking at this thing, and again, I watched Eric Sprott also, watched what he had done from 2001 all the way up to 2008 when he took his company public. And so I started to build positions, and we built the positions because we're concerned about the long-term fiscal stability in the global economy. Okay, so I think you have to know why you're buying gold if you're an investor. It's not just for speculating because it's gone up a lot. And we've built positions over the last 16 years. And that's slowly gone up as a weighting until, as you point out, it's close to 25% now. And that's because things just continue to erode. The reasons why you want to own gold only become more powerful year after year after year, month after month after month. And that's this massive increase in debt, deglobalization. So with Trump coming in, you're now getting sort of East and West divide. That's going to, again, cause more friction with the US dollar and countries becoming less dependent on it. I think, again, the reserve currency status is still going to be alive and well for the time being, but it's less influential. And people are looking for an alternative, and particularly central banks. So you have seen large buying of gold now for a number of years where they've been adding to central banks. I think it's only recently that people are concerned now about the debasement trade. We've gone through COVID. We saw the shutting down of production. Mm-hmm. We saw the flooding of our economies with printed money. So what do you expect? You're going to get inflation. So all of a sudden, people have lost a lot of standard of living, and they're very concerned about the debasement trade. And at the same time, as the debasement trade is going on, you've got this rush to technology, to digitization, to AI, to data centers, robotics. And that's putting all this demand for energy. And energy production needs mining and needs resources. And so I think you've got a couple of things going on here that I think are encouraging investors. But I think the gold, we don't set targets, but we want to own it as insurance because we don't think that the debt situation is fixable.
I mean, 25% seems like more than insurance, right? So we've already seen such a tremendous run up. One could argue that much of your thesis has already played out. What do you say to that?
Yeah, I think it's third or fourth inning. I think we have a lot more to go. And I say that because the debt just continues to pile up, and the unfunded liabilities continue to grow. The populations continue to age, and the friction around the world geopolitically continues to increase.
It's interesting you say you had this position, an overweight position relative to the market since 2010, which meant for years you had to wear underperformance relative to the market, right? It was just not, gold didn't really start to become an asset that moved until kind of post-pandemic and then really got started in the last couple of years. Talk to me about that and how that is married to your philosophy. Because in the near term, yes, your performance then is exploded. But you, I imagine, had to wear a couple of years where people are saying, why are you owning gold stocks? We should be out there with like Meta and all,
Yeah, you get that from investors from time to time. And I think, as Rick Rule likes to say, you buy things that people hate, right? But seriously, some of our companies actually did quite well. Our Franco-Nevada continued to grow despite the fact that gold went sideways, and it went up for a little while, and then in 2016 it did drop, I think, down to about 1,050, and then it's been moving upwards. So we had to just continue to talk to our clients. They understood our positions. They believed in what we were doing. They understood the investment philosophy. We did have a number of positions that actually did reasonably well. I mean, vis-a-vis the market, they were getting 8-10% growth. So that helped. But we had some positions that went sideways and, were underwater for a while. And that's
because for a while, a lot of the gold stocks didn't even care what bullion was doing.
Yeah, because we were in the royalty companies.
So that was different.
So we've added a few miners more recently because I think the upside is huge. And the royalty companies have become more expensive. But the royalty companies chugged along fairly well. Now, but again, we go back to Wheaton Precious Metals. Wheaton Precious Metals is done exceptionally well. It's a great company. It's very well run. But they were in a dispute with CRA for a little while. And my goodness, we hung in there and bought more. And, we kept talking to the company. And yes, the CRA they thought was overreaching and so forth. But that stock was, $20. Now it's just under 200 and it's past 200. So, you have to, again, understand the business, look at the fundamentals, have convictions. Our thesis for why we own the precious metals continue to get stronger year after year. So we stick there. That's what our investors are paying us for our convictions.
So talk to me about how that is applied to silver, which is down 30% from its high, and that 30% drawdown happened in the span of a week, which
I've never seen anything like that.
You've
It's
never
crazy.
seen
It's
it.
crazy. Well, not that kind of volatility day after day. I mean, you're seeing 5 to 10% moves day after day. Now, most of our investments in precious metals would be gold. We do have, inevitably have silver exposure. I mean, Wheaton Precious Metals now has become about 40% silver. The rest of it is gold and a little cobalt and platinum. But so most of our exposure would be gold. I don't mind the silver exposure, but it is volatile. We know it's a wild, wild ride. But again, you go back to the silver dynamics. We look at the silver fundamentals. Silver has been in deficit in terms of, there's more demand than supply for the last 5 to 6 years now, the experts that follow all of this. Silver is going to be needed for the EV and all of the, the technology, green and a data center revolution in large way. And I do believe that silver has been depressed over the last number of years. Again, I'm not, try to stay away from conspiracy theories, but there's no question in my mind when you look at the volume of what silver trades on the derivative market. It's like 100 to 1 to the actual physical market. It's crazy. And so when you see the kind of smash downs from time to time with silver, our view was that of what will eventually end. And we've seen that more recently. Now,
meaning like the financial markets are distorting the real supply-demand dynamics and keeping the price lower.
Yeah, well, they're distorting the price discovery, the true price discovery. And you can do that as long as you're not demanding the physical. But over the last year and a half, as you probably know, investors of some sort all around the world are actually calling in the physical. Once the physical gets called in, you're not just trading pieces of paper, then you're going to have more price discovery. Now, more recently, as you pointed out, I mean, silver just continued to go up, and then it went literally parabolic in a couple of days. That's not healthy. And we are obviously not investing in that. We're looking for the longer term. So, I mean, we got to warn investors that if something just goes straight up, stand to the sidelines, take some money off the table, be very, very cautious. And I'm not going to profess to tell you that I know exactly what's been going on behind the scenes, but I know whatever's going on behind the scenes, it still can't obfuscate the supply-demand characteristics of the underlying commodity over the long term.
Do you step in here on the pullback, or you're still wary?
We haven't added to any of our positions at this point in time because we already are well positioned. We did not take any money off the table unless we had a client that just became even larger and they're overweight. For example, we had both Sandstorm Gold royalties and also Royal Gold, and they merged. And so investors ended up in some cases with a very large weighting, and we peeled that back just to put it into proper perspective.
Before we get into the mailbag, I mean, 25% of your fund is precious metals. What else you got in there?
Well, we have a combination of everything from financials, insurance companies, technology companies, consumer staple companies. So there's a mixed healthcare businesses. Royalty Pharma we own. So there's a number of other areas. We do like to be involved in six or seven different industries. Diversification is important. The fact that we've ended up with a little bit of a heavier weighting in the precious metals is indicative of our big macro concerns that we're very, very cognizant of.
In tech, I'd like to double click on that just because right now we are seeing an absolute bloodbath in software, and it seems very indiscriminate. Everything is under pressure. If you are a software company, even if you're growing 25%, I mean, Monday.com is growing 25%. It says we're going to keep growing 25%, and it's getting hammered because of the concern that AI is just going to be able to do what these software companies charge people to do. Are you sniffing around this area as a value investor to see what's being thrown out?
Yeah, no, absolutely. In fact, we just started adding a small position in ServiceNow. That's a company that's been knocked down significantly. And I think that there's a company where it is very much overstated, that they are incredibly important in integrating systems within companies, and they can use AI to make themselves more efficient and to drive their costs down, so that even they can be able to pass some of that savings on to some of their clients. So that's one I think that is just being indiscriminately thrown out, the bathwater. So that's an example of one. Yeah.
So that's interesting because that was down like 57% from its peak in 25. It's down at a multi-year low. And you did explain it, but I'd love to know a little bit more about the homework that goes into understanding, I guess, the moat around ServiceNow that you think that AI can't really disrupt.
Right. Yeah, I mean, we spend a lot of time. We've got a couple of guys that have spent a lot of time on ServiceNow, following what they do, talking to companies that have integrated their services, and then just trying to understand what AI would do with them. Talking to again other folks in the industry. And we just don't see that companies are going to be internally just pushing some buttons and having some automated system integrate their systems and be able to trust that. I mean, it just seems beyond at this point what's capable in terms of AI. So when we do that, we say, okay, AI is going to have an impact, no question. But in some ways, it'll make them, as we said, more efficient. They're going to be able to use AI in their business. I mean, AI is a powerful tool. But it's we just don't see it being able to integrate and do all of that extra work that is required by human interaction and specialized systems. I mean, they can also do very specialized systems that fine tune it specifically for companies. So again, that just we just don't see that's going to be the case.
It's true. Like when I try and do a specialized function on ChatGPT, even if it really it can't go. When I try and push it just a little bit further, it completely.
Yeah, and you look at some of these companies. We don't have any Thomson Reuters, for example, but we're looking at Thomson Reuters. It's been taken out to behind the woodshed and beaten up, along with Wolters Kluwer also, which are it's a similar technology information company that
Which
trades.
one's that?
Wolters Kluwer. So that would be out in Europe. It's European.
Okay.
It's the same business model as Thomson Reuters. But again, you find like Westlaw, for example, which is part of Thomson. We're looking at Thomson's business and seeing, it's down by half. They've lost 50% of the value too. But Westlaw is all proprietary information. I mean, if AI starts to, first of all, it's very difficult to get in on the information. If they did, they could. They have patents on that. They can sue them. They can go after them. So there's going to be some limitations to what AI can do because there's going to be very much protected information. So that's where we're poking around, looking at, all of a sudden they've gone from a free cash flow yield of 2-3%. I mean, Thomson was expensive. That's why we didn't own it. But all of a sudden now you got 5%, 6% free cash flow yields on these businesses. Some of these software companies, Constellation is probably it might be 8, 9, 10% free cash flow yields in some of these businesses. So they're starting to become quite cheap. So you have to do the work, though. I mean, we're still we have to build up a real comfort zone that AI will not erode, again, some of the moats around these businesses.
Constellation's going to come up in the mailbag, so I won't get your thoughts on that. But just hearing you talk about Thomson Reuters, I mean, even the exchanges, like a TMX group, so expensive. No analyst wanted to put a buy on it, even though it kept getting higher and higher. Yeah. And now it's trading at a 52-week low on a couple of concerns, but AI is one of them.
Yeah. No, and so what we're trying to do is find the businesses that we think AI will have limited impact. Where we are not sure, stay away from them to see what's happening. Because the benefit we have is we only need 20 stocks in a portfolio. So we're watching all this mess and we're seeing, is this bloodshed over here? But we're not going to jump in front of it unless we really build up a strong comfort in the company. But so I would warn investors, while this is happening, we don't really know in some cases. We're going to have to see the next number of months go by. I think there's some businesses where, again, it's proprietary. AI is not going to hammer them. I mean, we have a small position in a company called Kelly Partners Group, which is they're out of Australia. And they're now in the United States and in the UK, and they are consolidating CPA firms, so accounting firms. Wow. It's a neat little company. We think it's probably trading at 1/3 its value, what it's really worth. And it's been hammered because of AI. Where accounting firms, I mean, AI is not going to get rid of accounting firms. No. They're going to use AI in their business, but this is one where it's just been thrown right out. And it makes no sense to us at all. That's just a $200-300 million company. But it's an example. The fellow that runs that is incredibly bright, and he's built an amazing business. He's had he's watched Constellation as an example. He's had some of those guys on his board. But that's one where it's dropped probably half of its value, and he's growing 25, 30% a year, making a ton of money. And he's got a whole host of businesses that he can consolidate. In fact, here's an opportunity that we're seeing is that we got private equity have bought a lot of these software companies, and they're going to have to vomit them out. And so it's same thing with these CPA firms. There's these people are trying to consolidate CPA firms, but if they're in private equity, they don't have disciplined capital. And so they're gonna have investors barking all over them. And so some of these companies could be coming to market really cheap. And so we're kind of watching our some of the publicly traded disciplined companies able to pick up some great opportunities in some of these spaces. Yeah.
Okay, well, let's find out what some of those opportunities are, and we'll dip into the mailbag. The mailbag is brought to you by BMO ETFs. If you're a do-it-yourself investor looking to take control of your portfolio, BMO ETFs makes it easy. Whether you're exploring stock replacement strategies or you want to find ETFs that hold your favorite companies, their tools are built to help you invest smarter. Check out the ETF Compare tool, the stock replacement tool, and news and insights under the tools section at bmoetfs.com. It's perfect for analyzing your options, spotting trends, and building a portfolio that fits your goals and timeline. First, I'm going to start with some of the mining sector because we spent so much time talking about that. And you already mentioned how much you love Wheaton Precious Metals. The question is coming from a gentleman named Brick. Have I missed the opportunity to buy? And Wheaton is also going to be going through a management change, right?
Randy
Long-time CEO Randy Smallwood leaving the helm.
Yeah, Randy's going to be the chairman of the board, and that's a natural transition. He's been there since the beginning, right? He's done an amazing job. So, I mean, they've got some good talent around them. We saw the same thing with Franco-Nevada. You know, the changing of the guard, but providing you've got really strong people that are taking over that share the same, company ethos and discipline of capital allocation. That's the key. So that certainly, I think, is the case with Wheaton. No, we like Wheaton. It's not inexpensive. I mean, it trades at a 2.5 times or more multiple of NAV, where I think that we still own it, and we're not interested in selling it. We think that where some of the opportunities going forward with Wheaton are going to be is with the big copper development. So there's a lot of large developments in the mining sector that are going to require capital. And as you know, silver in particular really comes as a byproduct. And so they'll be able to help fund some of these large copper projects. We need a lot more copper. Copper is something that's in short supply. In fact, most estimates suggest we'll need another maybe 70% more copper in the next 15 to 30 years.
But if I'm a shareholder in Wheaton, do I want that? Like, aren't I buying Wheaton for more precious metals exposure?
Yeah, but they want the copper. What they'll do is they'll do the deal on the silver byproduct. Okay, they'll do the deal on the silver byproduct. And because Wheaton has one of the lowest costs of capital, it really is a benefit to the copper company to sell that silver byproduct off to Wheaton. And I think that you're going to see, as we talk to people in the industry, you're going to see some multi-billion-dollar royalties. These royalties are going to get really large. And that, I think, could be a long-term opportunity again for Wheaton because they are large and they're going to need to have large deals to be able to keep the growth going. Interestingly enough, Randy Smallwood, just on the last earnings call, and I was listening to him, he had suggested that because the price of gold and silver and the commodities are up in general, it's sped up all of the development of the underlying companies they have royalties and streams on.
That's going to come faster.
So he's seeing 40% extra growth in the next 4 years on their business. So there's a lot going on there. I think the other thing investors should, as questions come in that you need to focus on, is if the price of gold and silver continue to go up, then all the net asset values, they all go up also. And so just because Wheaton's gone up, by 100%, or some of the other companies, Agnico Eagle, are up 100%, that doesn't mean they're expensive. Not if silver's gone up by 200% and gold's up 100% and could go higher. So it all depends really on what you think in terms of your target prices for some of these commodities.
Well, let's talk about miners, which you've said that you've been adding to. We got a question on Agnico Eagle. That's sort of like feel like the Royal Bank of gold mining. Like
it is
feels
phenomenal,
like the safest bet.
phenomenal business. I mean, Sean Boyd's an amazing job. I mean, he should be getting nothing but gold medals. I mean, it is phenomenal the way he's run that business. No question about it. In every way, shape, or form. I talk to people that are involved in the business on different levels, and they just have nothing but respect for the man and the way he runs the business and the way he funds the communities he's in and so forth. I mean, it's an amazing company. Yeah, but if you look at Agnico Eagle, the interesting thing about that, I just ran some numbers recently. If you believe gold is going to stay in the price range we see now, $5,000, then Agnico Eagle is not expensive, and they're going to generate a free cash flow yield of probably around 8%. I mean, they're going to mint money. So what people have to understand is that, their cost is $1,000 per ounce and gold's at 2,000. Okay, they're making a 50%, they're making, the double the margin. So they're making $1,000, profit. But if gold goes to, 4,000, their costs, they'll come up a little bit, but not that much. All of that goes to bottom line. And so they become incredibly profitable. I think that's what you're going to see in the next number of quarters as some of these gold companies release their numbers. Now, I won't see it by all of them. Some of them are not as well run, and some of them, costs will start to escalate. But the profitability, I mean, that's a moving number. So I think Agnico Eagle at these prices is something that you want to own.
And again, like a relatively safe play. Same with Wheaton Precious Metals, right? These are on the more defensive spectrum of risk when you're investing in commodities. It's hard to talk about a stock that's doubled over the past year as a lagging stock, but technically those stocks have lagged the TSX Gold Index, particularly because it's such a risk-on environment. People are they want more torque. They go to the juniors. They go to something more speculative. How much do you dabble there? And what is your advice to people who say, okay, I'm all in, so now I want to go further out into risk. I want to go smaller cap junior mining.
Yeah, you really have to know what you're doing there. I mean, you really, really have to be careful because these are businesses that are much more speculative. So what we do in our portfolios, we do have some clients who would like to have a little bit more juice, a little more octane, if you will, beta, a little more alpha. And so we will sometimes pick up the Sprott ETF. They have a silver miners, silver ETF that we'll pick up for some investors. And
then you're still diversified.
We're diversifying. So we do not want to buy very many junior miners. There's just so many things that can go wrong, and that's not our expertise. We have to be very, very careful. One of the things about Warren Buffett tells you, know your circle of competence, right? And that falls outside our circle of competence. Now, we do have one or two smaller positions on our books that we've gotten to know management and we've gotten to know the business, and they've de-risked a lot of their business. Then we'll hold some of that. But our major positions would be, in terms of miners, Agnico, Pan America. We do have a little bit in Equinox. Again, these ROCKLINC. So we're going to look.
That was a turnaround. We had him on the show in the summer, and kind of as he came on, it was like a week or two later. Then everything started to get better. But it was an embattled story for a while. Yeah,
absolutely. So if we're going to buy a miner that's a bit smaller, below the Agnico Eagle size, then it has to be one that's got an incredibly strong investor in it, like a ROCKLINC, reputation, incredible board, in a good country, and well financed. So, we're not going to start to get into juniors that are out looking at it for exploration. So we're very careful there. That's just not the game we play, and that's not what our investors expect from us.
Let's pivot to another area, uranium, which has been hot. Kind of a byproduct of the AI trade, not just AI, but it's really gotten going since then. Uranium prices are flying. And so we have Cameco here. Do you like the stock? How do you value something like Cameco when it's maybe like a little bit you're a value investor, and sometimes momentum favors value?
Yeah, no question. And we do have some Cameco on the book. We don't have a lot in the uranium space, although I would argue from everything that we read and all the people that we talk to, and it's pretty obvious, nuclear has really changed. I mean, both left and right politically are behind nuclear, and so you do have a renaissance in nuclear energy. And we have some exposure to some of the Brookfield assets who invested with Westinghouse and so forth, which again with Cameco
and the U.S. government
also, yeah. And so we do own Cameco. So how do you value that business? You look at it at price to net asset value. It trades about 2.5 times now. First of all, the company is incredibly well run. I mean, it's an amazing company. We've talked to the company a number of times, and I'm always just blown away at how disciplined they are. I mean, they don't develop anything unless they are going to make a return on it. They'll buy uranium in the market before they develop their own, just to safeguard their own long-term reserves. This is a company also that has massive, massive reserves. I mean, if you do a net present value, it's going to go out decades. It's it's got 17% of the market share in the world. It's the second largest in the world. So the way we also look at it would just be what your expectations of the uranium price is. So, the uranium price now is, sort of the $80 range. So they're generating at $75 a 2.5% free cash flow yield. If it goes to 100, their free cash flow yield goes to about 4 or 5%, which becomes, pretty, all of a sudden more interesting. If you think uranium is going to continue to move up over the next number of years, say to 150, then you're getting up to 6 to 7% free cash flow yield.
Can it not? So, if we're going to rely on this as a power source, it can't. It's going to fall into the oil trap a little bit, right? It can't get too expensive.
No, and I think that's why if you're going to buy Cameco at this point, it's had a great run. You believe that you're going to see consistently uranium prices getting north of $100. I'm not talking $200-$300, but you'd want to see prices a little bit higher than they are today in order to really get some kind of economic return on it. But it is an amazing, well-run company, and we're fortunate to have those kind of assets in Canada. Yeah. Okay,
let's switch a little bit to the financials. We have a question on Berkshire. So, you're a disciple of Warren Buffett, and I always wonder which of those disciples actually own Berkshire in the portfolio, because you can study Warren Buffett, but the stock feels like something different altogether. So the question is, do you think Berkshire will outperform the S&P over the next 12 to 24 months?
Yeah, and just for full disclosure, we have limited exposure to Berkshire at this point. We have some clients that have it, and some massive capital gains, and we follow the company. Yeah, so that's a great question, and I think the answer to that question really is, how aggressive do you think the S&P is going to do? And that sounds like a rather simple answer, but if you look at Berkshire, it's $1.1 trillion market cap. Okay, $1.1 trillion. $400 billion, I should say. So, just under 40% is in treasuries, in short-term securities. So the other parts of the business are very profitable, generate cash flow, it's insurance operations, and so forth. But if the S&P is going to do high single digits, low double digits the next year, I think Berkshire will underperform it. If the S&P tumbles and has a brutally difficult time, then clearly Berkshire is going to outperform it. And not only outperform it, it could set itself up for some great investments, because that's what they're waiting for. They're waiting for a down market. So I think if you're owning Berkshire now, you're owning it as a very safe way to pick up mid-single digits kind of return, and you're waiting for a market drop. Otherwise, I don't think, again, the Berkshire is interesting, unless, again, they come and they start to take the business apart and sell off parts of it, which I doubt they're going to be doing that anytime soon.
Do you have that view? Do you have a view on the S&P 500?
Yeah, our view on the S&P 500 is expensive. So when we're looking at businesses, we're trying to buy businesses sort of underneath the hood, if you will, that are cheaper and trading at better valuations and have higher growth rates. So yeah, I mean, when you look at any of the benchmarks, these major indexes, they're trading at high price to earnings ratios, high price to cash flow, price to revenue, and so on. So I think investors need to be careful. Having said that, you are seeing a bit of a rotation going on in the marketplace, which I think is healthy. You can't just walk up to tech stocks all the time, right? And so you are seeing, manufacturing companies, construction businesses, housing companies, a whole host of businesses underneath the surface starting to do better. The Russell 2000 has gone up a fair bit and stuff like that. So you're getting this value, I think, a bit more of a value rotation, which would be healthy. So the answer to that question on Berkshire, I think it'll plot along with the S&P 500, but the biggest opportunity there, other than just protecting your capital, which it will protect your capital, is if there is a tumble, they will not go down anywhere near as much, and that will give them an opportunity to deploy capital, which is what they've been waiting for. So that's the way I would view Berkshire.
It's interesting you talk about this rotation to value. It can't always be tech. We had a guest on who's also a value investor who said, but look at the Russell Value Index, and the biggest holdings are Alphabet, Amazon, and Meta. So even the value, value means something different to everybody.
That's why we don't own any indexes. I just think they become so dominated by a few companies that we just love to have, that market, the market share, which is totally different than the index as much as possible anyway.
Okay, let's contrast those thoughts with, we got a couple of questions actually on the insurance space, including Fairfax, from a fund that seems to know you and knows that your top two positions are Trisura and Markel Group, but not Fairfax. I'm curious what you think about Fairfax and what your expected returns are for all three stocks in the next 5 years. And this is coming from Brown Maribosa, who always asks about Fairfax, but I feel like you're in good position to answer this question.
Yeah. Well, Trisura was a spin out of Brookfield, and they've done, I think, a great job in insurance brokerage, high-end surety insurance and so on. So again, it's not an underwriting company; it's really a brokerage firm to a large degree, fronting. And that business trades really on forward earnings, maybe 15 times. It's not an expensive business, and they're growing at again similar rates. So they'd have a peg rate of about 1, and we like that business. We think it's very well run, it continues to grow, and it's not overly expensive. So that's sort of our view on Trisura.
Trisura, I thought was interesting. I think there's some M&A going on like elsewhere, which might be driving up interest in the whole group. But when you said 15 times earnings, is it not apples to apples of other insurance companies? Because, as you said, it's a broker. So you might look on a PE multiple, it's more expensive than like a Sun Life. And I know it's a different business, but is it not really apples to apples comparison to look at that versus you're
going to look at price to book, you'll look at price to sales, and you'll look at PE ratios, and so you'll look at a number of parameters. But I guess I just throw out the PE, just give people a sense that it's not overly expensive just on a price earnings multiple. Although you're going to look at probably price to book if you're looking at a Fairfax or looking at a Markel. They're different because they're large underwriters. So you have a bit of a difference. But Trisura, when you have a business that's trading at a price to earnings, and earnings is a good reflection of their profitability of 15 times and maybe even lower, and they're growing at that amount every year. It's very hard to buy a well-run company with a peg rate, of 1.
Yeah.
And
that's price to earnings growth.
Yeah, price to earnings growth, and they continue to grow book value very quickly, and so we think it's a rather safe business from that perspective. You don't have any kind of big catastrophic risk involved in it.
So have you ever owned Fairfax? Do you own Fairfax?
Fairfax is a great story because, when I joined Michael, we owned Fairfax at $11. So we took Fairfax from $11 up to $600 and then back to $300. And then we were out of it actually. And then he Prem had a tough go at it for a while. He had hedge funds attacking him and doing all sorts of things. And so, we made a lot of money off Fairfax in the early days, and have tremendous respect for Prem Watsa. We haven't owned it more recently, not because there's anything wrong with the company, because we just feel comfortable with a couple of other insurance companies like Markel. And we just added another one recently, just a small company, which we really think is really fascinating. And that's American Coastal Insurance Company, ACIC. And that's a $600 million company. And it's out of Florida, and everybody thinks, oh, Florida hurricanes.
That all seems terrible.
They don't want to invest in that. But these guys, again, they have reinsurance beyond $50 million. They really know how to write incredible, profitable business on commercial properties, condos and stuff.
Cheap.
And they're incredibly dirt cheap. And we spent a lot of time, with the company, talking with the company. So we're actually building a little position there. They're now taking their expertise in the Florida market. They've got combined ratios consistently 60 and 65 to 70%. It's unbelievable how profitable they are. Plus their investment portfolios, which is one way I look at them too. Their investment portfolios, in terms of their assets per share, is larger than what you pay for the shares. So if you're paying $11 for the stock and you're getting $13, $14 in investable assets per $11. The way I look at that is you're buying a bond fund and you're getting it at a discount. Plus you're getting a company that's making profits on their underwriting at a high degree of profitability if you're getting a combined ratio of 65 and 70%. So they're really doing well. They do special dividends from time to time. So they just did a special dividend of 75 cents on $11 stock, 50 cents last year. They're going into Arizona right now, and they'll be also going into Texas and South Carolina, which are adjacent markets where they have some expertise also. So you can find these great pockets of opportunities in the insurance industry. But Fairfax, I love what the company's done. We just have some other opportunities. And should I've owned Fairfax the last year and a half? Absolutely. And hats off to Prem, who's really built a great company.
Can't win them all. Let's talk about Constellation Software. We'll end the mailbag with Constellation because such a darling for a really long time. And then I bought it. So then it has underperformed basically. So I apologize to everybody for that. But it has really been caught up. Well, I think in two things. Also, management transition, a sudden one because of the health issues of Mark Leonard and because of question marks around that very question. What is AI going to do to Constellation's modus operandi, which is buying software companies, fattening up the margins, and making it more profitable?
Yeah, so we don't own Constellation, and we have looked at it, and we continue to sort of look at it. And are trying to sort of form an opinion because it's not easy because all the AI swirling around, you're trying to get a sense on what the impact is. But I mean, it is a business so that, again, as you say, it was a darling. It became became expensive. I mean, when it hit 4,000 and change, it was starting to get just a little bit crazy on a free cash flow basis and so on. So what I would say to investors is just be patient the next little while. And let's just see how the next couple of quarters go. Yeah, you might not be able to buy it at the low, and maybe it goes up a little bit, but that's not a bad thing. It's better to build a little bit more certainty in terms of what's happening on the business with AI erosion. And whether they can continue to grow quickly. Now, their numbers most recently were great numbers. I mean, their numbers were spectacular in terms of the top line numbers. Now, organic growth on the businesses that they own starting to come down a little bit. That's a concern. That's what I'd be really watching, because it's that organic growth. If that goes to almost nothing, then I think you're seeing erosion by maybe AI and difficulty in terms of growing that business. And it just can't. You just don't want to buy a business that's only growing because of acquisition. In my view, I'm very, very cautious about that. That's just a principle that I've had over the years. Yeah. Again, depending on the price. I mean, if the prices are dirt cheap, then of course you're going to buy anything. But if a company can't, it's just growing by acquisition because they trade at a higher multiple than the companies that they're buying, but they can't grow those companies organically, then it's eventually you're going to hit a wall. And so I think with Constellation, I would like to just really, really watch that. That's what we're doing. Can they continue to make these acquisitions? Are they out there? Can they grow them organically? Is the organic growth coming down too fast? And integration, and we'll watch that. And then let's just see what the AI does. But right now, it does appear cheap. It's trading at a reasonable multiple, so it's becoming quite tantalizing, I guess.
You got to be wary of value traps, which we haven't talked about yet. Like, what's your signposts for avoiding value traps? You can't just buy any old cheap thing.
No, and that's the thing is, we've looked at different businesses over the years. Like for one example, we look at a business and it always looks cheap, and that's U-Haul.
Okay.
And U-Haul is a fascinating company. It's got all these assets and it's a family controls, I think 40% of it or more, and so forth. And it always looks cheap. And it always stays cheap.
Yeah.
and we haven't owned it. And there's, with COVID and people weren't moving around and there was a whole host of things that got hammered, right? And so it looked like this would be a great time to buy it once the economy started moving again, they opened things back up again. And it did come up, but then back down again, and the cost of trucks and things like that. There's a whole bunch of, asset issues with it too. But you're quite right. You can find these companies, you go on every kind of measure, it looks cheap. And it looks like there's growth opportunities, and it just goes sideways and sideways and sideways, and it drives you crazy. So we try our best to get out of the stay away from those companies. And if we do own one, I'm just trying to think in my mind, if we own something that has gone sideways for a long time, sometimes we just pitch it.
It's not doing what you want.
Yeah, because again, we have 18, 20 companies. So it's a pruning process. If we find something else that's better, then we'll just move over to that. Yeah, that kind of discipline. Yeah.
Okay, well, let's find out what you are adding, what you do like. Let's get into your pro picks. ProPicks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, so value manager, you do have a lot of precious metals, but you're diversified. And so you've brought us a basket of diversified, probably not household names, certainly not with your first pick. The first one is Carlyle Companies. Not Carlyle Group, the private equity company. It's Carlyle Companies, ticker CSL on the New York Stock Exchange. Roofing.
Yeah, I mean, roofing, weather protection for buildings, siding, cladding. They're one of the dominant leaders in the United States. Interestingly enough, Berkshire Hathaway also controls a roofing company similar to Carlyle, which they bought 100%. But it's one of those businesses, when you think of all the flat roofs and the roofs across all the industrial businesses in the United States, it's just an annuity stream. They all have to be repaired, after a certain number of years. They're looking for, new technologies. It's still a highly fragmented business. So Carlyle is able to buy up smaller players so it can do, again, acquisitions, consolidate. It's a business that generates literally, 30% return on equity, returns on invested capital of in mid-20s. I mean, this is an incredibly profitable company. Buyback stock, dividends. Why do we like it now? And we've owned it now for a number of months. We haven't owned it for a long period of time. Is because people were so negative about construction industry and the building industry, and interest rates had just gone up an awful lot across most of the markets. And so it was one of those ones that was just overlooked, and it had dropped in value, and no one cared, even though it was continued to grow, and it's amazingly profitable. So it's one of those boring companies that just continues to make money and more money year after year, and great returns on invested capital.
And I guess if you caught in the last couple of months, that's a great time, because it was one of those, darned sideways traders for a while, but then it came out with earnings. And I in looking at the results, they're trying to shift the business to more profitable areas. So are you, as part of your bet also that they've caught an inflection?
Yes, yeah, no, they are altering the business, changing the business, flexing it to higher value added areas. Even with the reshoring in the United States, most of the business in the United States, there should be more development. They're involved in some of the builds of the data centers and so forth. Now that's a small additional add to their business, but these are all helpful additions, and they have increasing a lot of money in R&D, so specialized technology. So if you're a smaller roofing business, you can't keep up with them. The new kind of materials that they're developing for roofing and siding, cladding is quite amazing as we've studied it. So again, they get that moat, and it's going to be difficult to displace them. It's really an oligopoly for some of these big businesses in that area. That's why Warren Buffett owns one of them.
Your second pick is Mercado Libre, not a household name here, but is in Latin America, specifically areas like Brazil, kind of like an Amazon.
It is, yeah. I mean, they operate throughout South America, 18 countries. It's a number one brand in terms of presence down there on the internet. It's about 3 times the size of Amazon. Amazon is in South America, so the dominant presence and e-commerce. We like South America. We think over the next little while could do quite well. So it's almost a play on South America. We've seen more conservative governments being elected. Mining and extraction is going to be more important in some of these economies. And so that could be a benefit, especially, again, with the Trump government trying to establish a better sort of Western Hemisphere approach. And Mercado Libre, the other thing is only 5-6% of the market really is doing e-commerce. So it's very embryonic. So there's a lot more growth. It's not like it is in North America. And they also have relationships with advertisers. They have over 100,000 advertisers on their system. They got 22 million, customers and businesses that are involved. It's a really growing business. They also have Mercado Pago, P-A-G-O, maybe I pronounced it wrong, P-A-G-O, but that's a finance company. So they're also providing financing for people that are doing the e-commerce, over $250 billion now a year in finance that they're doing. So they're also a fintech company throughout South America. So it's an interesting combination, very well run, very well respected. And that trades at a free cash flow yield of about 8%. So you're talking about maybe, one quarter of the value of Amazon in terms of when
Free
you get
cash
to
flow.
free cash flow. And you get
Let
to
me
metrics.
push back on that because I'm just looking at the estimated multiples. And guess what? Amazon's cheaper. 26 times versus Mercado Libre, which is 48 times. These are the Bloomberg estimates, so you might have
we've been looking at the free cash flow.
The free okay, so that's interesting. And I think part of why Mercado Libre has recently underperformed is on concerns of competitive threats from Amazon, which is expanding in some of their key markets. That's not enough for you to kind of have your conviction shaken.
No, because we think that the Amazon can continue to grow, and Mercado Libre also will continue to grow quickly. And it's such an underpenetrated market; they can both do quite well. But Amazon has had trouble in other markets outside of North America. They are not unbeatable. They've had to backtrack in some of their markets over in Europe and so on. So I'm not so sure. Our view is that we'll see. I mean, we like Amazon. We've owned Amazon for many years in some of our portfolios. But we think you can compete against them. And in South America, the South Americans throughout the many different countries in South America might like more of a domestic player rather than going to a big Amazon. So and they are multiple sizes of what Amazon is, and they continue to invest back in their business too. So and at the prices that you're paying, again on a free cash flow multiple, we think it's relatively cheap.
Your third one is Sprott. It's such a beneficiary of the gold trade, of the precious metals trade, even the uranium trade, because they've got their uranium ETF. Their assets under management has exploded. And I think now when they report, it's going to be like $57 billion. That's what people think it will be up to.
Yeah, I think they topped 60, but we've had a bit of a pullback.
Yes, that's right. Yeah, so they'll be growing back to that level. Why Sprott now? And talk to me about, riding through these periods of volatility.
Yeah, I mean, we've owned Sprott a little bit for a number of years, the last 5-6 years. And so a couple of things. Sprott's interesting because it went public in 2008 at $1.5 billion market cap on less than $7 billion in assets. And I was back at AIC at the day, and we thought to myself, wow, Eric Sprott is really, really gouging the market here. But I mean, I say that in all due respect.
Yeah.
I mean, if you're going to go public and you're going to sell your stock, you do it when it's at a high.
Yeah.
It was incredibly expensive. And so, but he raised $200 million and off they went. And that was at $10 a share. But of course, they did a 10-for-1 reverse stock split in 2020. So that puts them at $100. So now they're at 160. Okay, approximately 160. So they've really only got up 60%. Now they've paid some dividends along the way and so forth. So you have to just look at the stock price. But it's kind of interesting. Now they have almost 60 billion US in assets, and they're trading at about 3 billion US market cap. Our view, now, again, you have to be very careful because when they first went public, they had a lot of hedge funds and they had performance fees, and that would swing their assets, how much they could pay to shareholders, and the margins were much higher and things like that. Obviously, they got ETFs and index funds. Your margins are much lower. So you have to be very careful comparing AUM to AUM. But our view is that that's a great way to play the commodity super cycle. If you believe that there's going to be a commodity super cycle, one of the best ways to play it is through an asset manager who is the leader in all of these various commodities. So if you look across their assets, as you said, uranium, nickel, copper, silver, gold, I mean, they've got every commodity covered in terms of these ETFs. And so I think, again, being an investor in mutual fund companies going back, 30 years.
There's a lot of parallels.
There's a great way to leverage the whole commodity super cycle. Now, it's not, where it's trading now, I'd say it's fairly valued. But I think if you believe that the commodity prices are going to continue to go up, they are going to leverage that in a beautiful way. They're going to get tremendous operating leverage in their business. They also have a tremendous brand. They've become synonymous with investing in commodities.
I mean, they were creating these ETFs when nobody wanted them.
Yeah.
They were like, cool, you're doing a physical uranium trust. Like that wasn't, that was well before.
They were committed because they believed in the commodity trade and what was going on in the bigger picture. And you got to give them the credit for that. I think the other thing I was going to say is that they are an attractive takeout candidate also. So that's another factor. I think I would be surprised if the company remains independent. I don't have any information on it, and I say this and they hear your show, they might get mad at me or something. But no, I think if you were a large asset manager and you wanted to pick up the best commodity name in the industry, and it's $3 billion US, and you would pay a premium to that, I think that's an attractive candidate for any large asset manager. The largest shareholder in the company right now, individual, is Rick Rule. He owns about 10% of it. And Rick's always in for a trade, so I don't think he would oppose that if he got a good valuation. And yes, and their reputation, I mean, they're known again for minimizing derivatives, having the real physical, and I think that's really paid off over the long term. Peter Grosskopf did a great job over the years building that business, and then it's been handed now to Whitney. And I think they're in a very nice position. But again, that's not one that just goes straight up tomorrow. I think they've done well. They've caught up in the marketplace. But I think that they're a real play on asset appreciation in the commodity space right across the board.
Well, we've had Rick on the show, so we'll make sure the next time he comes on, we ask him about that. What's the right price? Rick, I'm sure he will actually have an answer. I want to get
Well, he hasn't sold anything.
I know, yeah. I want to get a handle on risks, because you said, there was a pullback. They had 60 billion in assets. Now they could have 57 billion, go back to that. Like, how sticky are the hands in a downturn? How much might that be tested in Sprott's results? Because it was so swift, the recent volatility that we saw.
Yeah, it's a good question. If you're buying asset management companies, you do have to be prepared for volatility. And there's no question. I mean, again, I go back over 30 years, and I was always amazed when we bought, Trimark stock, going back, and or CI and things like that before they got involved in all the RIAs and the business that they've been doing now, but they were just a pure asset manager. Even though the asset management company, think about it, they manage bond funds, money market funds, Canadian equity funds, US equity funds, global equity funds. Their cash flow is actually pretty consistent. And yet the stock prices would be incredibly volatile. Mackenzie Financial, another one, was big back in the day. And so I think you have to be prepared for volatility. What would make Sprott even more volatile is because they have a lot of ETFs and money can come in and out very quickly. And so I think that's one that we just will watch. We do think this trade, though, has another 3-4 years behind it, if not more. And I think that they're well positioned. So it's one that you'd want to keep your eyes on. If the commodity trade started to disappear, and we didn't develop the super cycle and so forth, then I think you'd back off and take a little bit of money off the table. You want to watch that. I just think over the next number of years, it's one way to play the whole space, because they've got exposure to all of it. And if you believe that fiat currency, for example, is going to lose more and more purchasing power, which I think it's virtually impossible that it doesn't because of the debt, then that's one way to try to protect yourself through a diversified exposure to a lot of commodities in a business with a tremendous operating leverage.
Jonathan, it's been an absolute pleasure. Thank you so much for joining us on the podcast.
Great. Thank you very much, Amber. I enjoyed it.
That's Jonathan Wellum joining us of ROCKLINC. Don't miss our next episode. We are talking biotech. It has been left for dead for a number of years. Is it coming back to life? We've got Eden Rahim, who specializes in kind of these under-the-radar biotech companies that could potentially have some explosive upside. If you've got any questions on biotech stocks, you can email questions@inthemoneypod.com or find us anywhere on social media @inthemoneypod. And we'll see you on the next episode.